stop what you're doing right now. Literally, if you hold biotech stocks, you need to see this explainer immediately. Today, we're dissecting a company that looks like an absolute, undisputed, booming success story on paper. But, according to a blistering news short report, that growth, it might actually be a complete illusion. We are diving deep into the massive controversy surrounding ADMA Biologics. So, is this a fundamentally booming biotech stock poised for massive gains, or just a fragile house of cards propped up by financial engineering? It is a classic two-faced coin, and we're going to look at both sides impartially today so you can uncover the truth for yourself.
To set the stage here, consider this legendary quote from investing giant Peter Lynch. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. What would a legendary investor like Lynch think of ADMA's current situation? It's a fascinating question, because let's be real, as a retail investor, your absolute biggest fear is being left holding the bag while executives quietly head for the exits. By the end of this explainer, you'll know if ADM is following Lynch's golden rule, or if it's a massive value trap that completely inverts his logic.
Last week, when I started mapping out this stock's data, I ran their financials through some standard forensic checks, and what I found absolutely shocked me. I want to present you with this surprising number, 113. Keep that number right in the back of your mind. It's a critical financial metric buried super deep in the balance sheet, and honestly, it serves as the smoking gun for the massive controversy we're about to uncover. The contrast between ADMA's reported success and this hidden metric is, well, it's pretty terrifying.
Okay, so let's dive into this. Here is the clear, actionable framework we're going to use today to break this all down. First, we'll look at the ADMA growth story. Then, the short seller alarms. Third, we're unpacking a concept called channel stuffing. Fourth, the mystery of the ghost distributor. And finally, number 5, the insider buyback paradox.
Starting off with Section 1, the ADMA growth story.
If you pull up the company's official financial statements, it really does paint a picture of absolute operational excellence. According to ADM's Q1 2026 earnings, they are just crushing it. Adjusted EBITDA hit almost $60 million. Management, led by CEO Adam Grossman, laid out this incredibly ambitious long-term revenue target of over $1.1 billion by 2029. And crucially, they exited the quarter with a net leverage ratio below 0.5x. That gives them massive flexibility. They've paid down debt, they're generating profits. It looks great, right?
And the bullish indicators just keep coming. ADMA boasts expanding margins along with a 24% year-over-year EBITDA growth. Their flagship product, ASCENIV, which is an IVIG therapy with a high RSV titer blend, is reportedly seeing rapid, really robust demand. In fact, management was so confident that they announced a massive $200 million total share repurchase initiative. So from the company's perspective, this is a booming business executing flawlessly on its long-term objectives. Nothing to see here but growth.
But let's move to Section 2, the short seller alarms. As is pretty much always the case in the public markets, there is another perspective. In March 2026, a firm called Culper Research published a really scathing short report. Now, quick timeout. It's super important to remember that short sellers make money when a stock goes down, okay? So they absolutely have a vested interest here. But their forensic analysis of ADMA's own filings is what caused such an uproar on Wall Street. Culper alleges that the entire ASCENIV growth story is, well, an absolute fiction. Just look at this stark contrast. While ADMA reported their 2025 growth was up an impressive 20%, Culper Research did their own adjusted calculations based on inventory loading, and they claim the actual real end market demand resulted in a 3% decline. Now, you might be wondering, how on earth can a company report 20% growth if the actual usage of the product is allegedly shrinking? That brings us to Section 3, unpacking channel stuffing. Let's look at the mechanics of how that could even happen.
To understand the core of the short seller's argument, we kind of need to decode some financial jargon. What exactly is channel stuffing? Think of it this way. A company recognizes revenue when it ships its product to a distributor, right? Not necessarily when a patient actually uses it at the hospital. So channel stuffing is the practice of pushing excess inventory onto those middleman distributors, usually by offering them extended payment terms or heavy rebates, just so the parent company can claim those shipments as revenue onto these books. It artificially inflates reported sales, but it's like a ticking time bomb. It's completely unsustainable.
And Culper points to a striking piece of data as evidence for this. Remember that number 113 from the very beginning? Well, take a look at ADM's days sales outstanding.
This metric tracks how long it takes a company to actually collect hard cash after it makes a sale. Historically, ADMA collected its money in about 43 to 45 days. Pretty standard. But by the end of 2025, that number had absolutely skyrocketed to 113 days.
This creates a terrifying disconnect for investors. Notice how the adjusted EBITDA in dark blue practically goes vertical, soaring up to $231 million. But look at the red bars right next to it. The actual cash from operations they collected was only $50 million. They are reporting massive, record-breaking profits, but the actual cash isn't hitting their bank account at anywhere near the same rate. Culper argues this is simply because the product is just sitting on distributor shelves, totally unpaid for.
And the short report didn't just rely on spreadsheets. They actually interviewed people on the ground. One anonymous employee from a major ADMA distributor explicitly said, quote, "When I started, it was 45 days to pay. They're up to 90 now. That way we can bring in more product without any penalties." Wow. I mean, if that's true, this directly corroborates the allegation that ADMA is extending payment terms just to move product and juice up their reported revenue.
Moving on to Section 4, the ghost distributor, because it gets weirder.
See, the allegations don't stop at just inventory management. Culper research pointed out a bizarre coincidence regarding ADMA's secondary operations. ADMA appears to distribute some of its product through a company called Genesis Biopharma Services. But if you compare the corporate headquarters for Genesis Biopharma and ADMA's own corporate headquarters, they list the exact same address, 465 Route 17 South in Ramsey, New Jersey. Literally the exact same building.
And it gets even more tangled. According to the short seller, Genesis Bio appears to be controlled by none other than ADMA's own vice chairman, Gerald Grossman, via another entity called Technomed. Yet, Genesis Bio isn't disclosed as a subsidiary of ADMA, and ADMA hasn't clearly disclosed the full extent of its sales to Genesis Bio. The big fear here? Investors are wondering if related parties are secretly being used to warehouse all that excess product we just talked about.
Which brings us to our fifth and final section, the insider buyback paradox.
This is the grand finale of this whole saga, where corporate PR and actual executive actions seem to be living in two completely different universes. On a corporate level, ADMA is executing a $125 million accelerated share repurchase agreement with JP Morgan. The company is actively paying millions to buy its own stock back, right? Yet internally, the CFO unexpectedly announces his retirement at just 52 years old. And according to the short report, company insiders have been heavily selling off their own stock to the tune of over $50 million.
And then there's this SEC filing, which highlights another highly unusual maneuver. It reveals that CEO Adam Grossman actually pledged over 700,000 shares of his common stock as collateral for a personal margin line of credit with JP Morgan. Culper argues that for a company to lever up its balance sheet to buy back stock while its own executives are simultaneously selling or pledging their own shares, well, it looks a whole lot more like a desperate attempt to prop up the stock price rather than genuine conviction in the business.
So let's summarize the stark contradictions we've laid out today. It really is a two-faced coin. On one side, management highlights booming reported growth and expanding margins. On the other side, critics point to 113 days of uncollected cash and widening cash flow deficits. Management touts rapid market expansion. Skeptics point to a related party distributor quietly sharing their headquarters. And finally, you have a massive corporate stock buyback happening right alongside massive insider selling and sudden executive departures. Which leaves us for the ultimate question. Is ADMA a fundamentally booming biotech leveraging a savvy buyback to reward its shareholders? Or is it a fragile house of cards completely propped up by financial engineering and channel stuffing? We've presented the data from both the official filings and the short seller's forensic report. Now it's up to you to weigh the evidence. Thanks for joining me on this explainer, and always remember to keep questioning the numbers.